Welcome to the Explainer. We're jumping right into the tape for Wednesday, April 29th, 2026. And honestly, we're calling today's session the resilience test for a reason. Why? Because the market just managed to hold its ground against some massive geopolitical crosscurrents and some pretty critical commentary from the Fed. It was one of those days where the data tells a deeply fascinating story about exactly where the global economy is heading right now.
So, let's start by framing the broader market. Look at the S&P 500. It edged down just a tiny fraction, slipping a mere 2.85 points to close at 7,135.95. Basically, it's a flat line. And you know, what's really remarkable about this flat line is how well it held up considering the sheer wall of macroeconomic headwinds we were slamming into all session long. Over on the industrials, the Dow actually took the heaviest hit today. It shed just over 280 points, finishing at 48,861.81. That's a drop of just over 0.5%. And this specific decline, it really reflects some of that traditional, cyclical caution creeping back in as commodity prices flared up overnight, putting some serious pressure on industrial input costs. Meanwhile, check out the tech-heavy NASDAQ. It completely brushed off the broader pressure, managing to eke out a tiny gain of 0.04% to close at 24,673.24. So looking across the major indices, we've got a mixed picture, but the big takeaway? The market is holding the line despite an incredibly complex macro environment.
This dynamic right here illustrates the absolute tug-of-war of today's tape. On one side, your anchor, exceptional corporate earnings and undeniable consumer spending data, but pulling hard in the opposite direction, mounting macro fears. The Fed officially held rates steady today, which basically wiped out any lingering hopes of a near-term cut. Add to that an inflation-triggering spike in Brent crude, hitting $110.44 a barrel thanks to the ongoing U.S. blockade of Iranian ships. That specific combination keeps Treasury yields pinned high and keeps Wall Street deeply cautious. And yet, the market didn't break.
Part 1. Visa, Consumer Bellwether. To really understand why the market didn't buckle, we have to look at a company processing trillions in transactions. They're basically the ultimate real-time proxy for the global consumer economy. Look at this incredible move. Visa surged an absolutely massive 8.26% today, closing at $334.86. This wasn't just a quiet drift upward on low volume. We're talking explosive institutional buying. Visa acted as a critical pillar of support today, single-handedly keeping the broader indices from collapsing under those macro pressures.
And here's the fundamental driver behind that surge. Visa delivered a phenomenal earnings beat that explicitly shattered the whole tapped-out consumer narrative. Right now, the market is terrified that inflation and high borrowing costs are going to choke off economic growth, right? But Visa's hard, verifiable transaction volume proved the exact opposite. It showed that the American consumer is still swiping that card without a second thought. They are quite literally spending right through the pain of $110 oil.
Part 2. Starbucks, Margin Masterclass. Let's look at how this theme of consumer resilience builds even further. Starbucks climbed an impressive 8.45% to close at $105.50. This price action completely defied the broader market's cautious tone. And what it did was create a severe short squeeze dynamic, catching heavily shorted funds totally off guard and forcing them to aggressively cover their positions as the stock just ripped higher. So why did it rip higher? It's all about the fundamentals. Starbucks didn't just beat estimates, they actually raised their full-year outlook. Look at these underlying metrics. Same-store sales jumped 6.2%, and crucially, the average ticket size increased by 2.3%. Honestly, this is the holy grail for retail. By growing both foot traffic volume and increasing individual transaction sizes right in the middle of a brutal macro environment, Starbucks flexed some absolute unshakable pricing power. Turns out, consumers are still more than happy to pay a premium for their daily habits.
Part 3. Robinhood, Crypto Penalty.
Now, conversely, it wasn't all sunshine and consumer spending today. Let's pivot over to the fintech space, where we saw some incredibly swift and brutal punishment. Robinhood sank a painful 13.24%, closing way down at $71.20. And this wasn't on light trading. We saw massive volume exceeding 76 million shares. The stock completely shattered key technical support levels as portfolio managers literally sprinted for the exits to de-risk.
This move brilliantly illustrates the danger of holding high multiple growth stocks in our current environment. Robinhood suffered a devastating 47% year-over-year collapse in their cryptocurrency trading revenue. And look, when a key growth engine gets slashed essentially in half, the market reacts violently and immediately reprices the asset. The fundamental driver? Robinhood delivered a classic show-me quarter and totally failed to stick the landing. They missed on both Q1 revenue and EPS estimates. The lesson here is absolutely critical. When the Fed officially signals that interest rates are staying elevated, Wall Street has zero tolerance. If you're a high-multiple growth stock and you suffer severe revenue deceleration, institutional money will pull the plug in a heartbeat. They are pricing these platforms for absolute perfection. And well, Robinhood was far from perfect today.
Part 3. The water cooler. Okay, let's distill everything we've just covered. Here is exactly what you should say to your colleagues tomorrow morning about your market insights. Visa jumping over 8% to hit $334 today is the ultimate green light for our consumer discretionary allocations. Everyone's terrified of high oil and the Fed holding rates steady, but Visa just explicitly proved through hard transaction data that the consumer is still spending right through the pain. It's a great talking point to justify staying long on consumer resilience.
Next, for Starbucks, tell them this. Did you catch Starbucks surging 8.4% to cross 105 today? It's an absolute masterclass in brand loyalty and pricing power. When customers are actually spending 2.3% more per ticket, while foot traffic still grows 3.8% despite all the inflation noise, it means the brand moat is completely unshakable. It's the exact type of defensive consumer growth we need to be targeting right now. And finally offered this stark warning regarding Robinhood. Robinhood sinking 13% down to $71 today is exactly why we have to be extremely careful with high multiple growth stocks right now. Their crypto trading revenues fell 47% from last year, causing them to miss on the top and bottom lines. If the Fed is holding rates steady and you miss the street's expectations even slightly, institutional money will pull the plug immediately. It's a huge reminder that the market is currently pricing these fintech platforms for absolute perfection. Starbucks and Visa proved today that they have absolute pricing power despite a brutal macro environment. Which consumer brand do you think has the strongest, most unshakable moat right now? Comment below. Subscribe to Market Fluency for your daily edge.